dividend growers outperform every other one of those groups in the S&P substantially over time. If an aristocrat's growing their dividend at 1% just to stay in the index, and they're paying 130% of free cash flow to do it, that's a really easy to find red flag. I'd rather have a small moat that is expanding at all than I would a big moat that's overvalued potentially that might be leaking. If oxygen of a company is free cash flow, that's the best way to measure the health and the direction. The more important part of that question is letting your winners run and then cutting your losers. The best professional money managers in the world, if they get carried out on their shield eventually, and a lot do, it all has the same two ingredients: ego and no sell defense. Before you buy it, how do you know when you're out? And we have that answer before we started.
Ryan, welcome back to Excess Returns.
I am so glad to be here. It's great to see you too.
It's been a while since having you on, and since we had you on the first time, you've had some nice developments with the Freedom Day Dividend ETF. Ticker symbol on that is MBOX. It's MBOX. So congratulations on the fund's success. I mean, I know you always think of investing over the very long term, but I know it's been toggling between a 4 and 5 star Morningstar rated fund in the large cap value category. So that's a nice accomplishment and a testament to the strategy that we're going to talk about here with you today.
Well, thank you for noticing. And we had some of these talks when it was about 0.0. So I'm glad we're all still alive and kicking, and the market and the world may have tried to end a few times in between, and we're still here.
Very nice. So yeah, we'll today we wanted to have you on to talk about your approach to dividend investing, how it can work for people that are looking to live off of their retirements and live off their investments. And we'll dive into sort of where you sort of expertise is carved out is in the area of dividend growth and the importance of dividend growth when looking at buying stocks with dividends. So, I think that this is a topic that will resonate with our audience. So anyways, great to have you. What I want to do just to start though is, if, not a lot of people are going to be necessarily familiar with you. So can you talk about the idea of what your idea of Freedom Day actually is and how you kind of use that to, I guess, redefine retirement?
Happy to. The playbook here predates the ETF launch by about 26 years. So we've seen and been around at this for a while. The ETF just happens to be new, and we didn't know how those worked until not long ago. And then once I realized and learned all the benefits, I couldn't unlearn that. So then we had to jump down this steel cage match. And it really did feel like David versus Goliath. But the background for Freedom Day is way more important and bigger than any investment account, including this one and mine, which is I just saw retirement planning starting on Wall Street before we launched our own RIA in 2006. I saw too much anxiety. And my guess was that the markets weren't going to do anybody any favors. They were always going to be confusing. So how could we reframe, and not just feelings, but actual hardcore math? So defining, instead of a retirement age or an asset number, which I think left to their own devices, most investors are shooting for some big number and they can't figure out what it's supposed to be. And that causes a lot of anxiety. So we just flipped the script and said, what if we focus on free cash flow? And both the portfolio manager side of my brain is speaking here. If that's one of the things that most business analysts and portfolio managers would say is most important in analyzing a company, I would submit, why wouldn't individual investors require the same of their own plan? So starting with that framework, instead of a number, an asset number, Freedom Day to us is defined by multiple streams of income, both secured, fixed, and insured, not in the stock market, and rising in the form of dividend growers, along with a cash contingency bucket that when those streams exceed your needs and wants, then your Freedom Day has arrived at any age and at any asset number. And that has been an aha moment for people in the low six figures to $50 and $100 million that trust us. It has nothing to do with the asset number. It has everything to do with their lifestyle in the end. So that's what Freedom Day has meant to us.
You mentioned the learning the benefits of the ETF wrapper. So maybe just, is that what led you to actually say, we need to launch this within sort of the ETF framework, or what kind of got you to the ETF?
Well, I take no credit. The original idea that I was not looking for. So we had a separately managed account program, the exact same repeatable selection process and disciplines that we're using today. Inside the ETF, we've been using all that time in separately managed accounts, which growing up on Wall Street, that was a tax efficient, high end solution compared to mutual funds and indexes, in our opinions. I give credit to advisors who actually ask me, and it was inspiring, and I owe a debt of gratitude when they ask, hey, can you do for us what you're doing for yourself? And we're not at your firm. What about this ETF idea? And it was not something I was looking for. It was an enormous project that I did not need to spend several years for, because everything was going just fine. But what it unlocked was so much better. Because not only is it just plain and simple more tax efficient and cost effective for the investors, but then I could also share it with people outside these walls. And that was inspiring to me. So I couldn't unlearn that. I couldn't go back, no matter how much it was going to cost me. And I remember vividly doing an interview with Bloomberg. I said, why wouldn't every RIA do this for separately managed account programs? I was like, not too many I know want to take a pay cut. And I was happy to do that because it was my best way of saying, if I'm going to be around here for another 30 years, what better way to signal that?
Yeah, that's the thing. It's like you have to take the short-term pain or maybe a little bit loss of fees for the long-term benefit for you and your clients, particularly taxable clients. I'm just curious on the SMA. I always find it interesting. Like sometimes, like when SMA investors can see the individual stocks, they can see the changes happening. The perception might be that there's more work happening and there's more value, because within the ETF, you don't see any of that. So just, I don't know, talk to that idea of some investors like to see things, but actually in the end, the ETF is just so much more efficient and so much more valuable.
Well, our brains usually travel along similar wavelengths. That was my personal biggest fear, because I believe so much of the success I've seen for investors, take myself out of it for a second, it is the conditioning and being able to look at, oh my gosh, that history in my account of being a stakeholder in those businesses, and I'm up 100, 800, 1800% over time. And look, that's sticky and that helps. And you don't see that and you don't get to look under the hood. I thought that would be, frankly, a risk. So to be clear, it was not a one size fits all. Everybody has to do this. For taxable accounts, especially, we still run separately managed accounts. If it wasn't a no-brainer immediate upgrade, then we didn't convert. But to your point, I do think it's a little bit of an adjustment. I guess at the time, although it's not a big deal now, I thought the whole, remember the debate of transparent holdings or non, and portfolio managers worried about giving away trade secrets. Once you get past that, I mean, anybody, and they do, can look at our holdings under the hood just like they used to in their own account any day on the website. So it's all clear. But I think that was a hurdle mentally that I had to get over, because I agree with you.
Can you just talk, let's kind of step into dividends a little bit here. So a lot of times investors will, if they're looking for investment ideas, screening for stocks, might screen on the highest dividend yielders, or maybe put a minimum in, like I want at least, 6% dividend yield, where, your focus is on yield, but also the growth of the dividends over time. So can you just talk to that distinction and why it's important in your view?
So this was my own biggest aha moment. When you do the simple back of the envelope math, which I would like any investor to be able to do when I'm not in the room, I think that's key, because once you get your own head around it and you believe in it, you're more likely to stick with what will keep working no matter the fluctuation. So just doing the simple back of the envelope math. And my favorite example, one of those advisors that helped launch the ETF, to your other question, they came to find me only because of an article I did and research that we shared on the Mike and drill, comparing the layups in basketball to the big 3-point shots. Similar to your question, why would you want a 2.2% dividend yield when you could make 3? And the entire NBA agrees 3 is the only way to go now. Well, we went through the math and the history, but since it's baseball season, I'll go with my favorite example of Yogi Berra math of arguably the best winner in the history of team sports that not a lot of people know his history. And this is an oddly shaped 5'7" guy that used to live nearby me in Houston for a little while. And his lifetime career average to get to the most success for when it mattered most was a reasonable, but not gaudy 285. If you are a baseball, 285 average. And this is a nerd who grew up, my first job was in the back of a baseball card shop. This is where my love of numbers came. So that Yogi Berra math, to your question, is a simple low dividend yield of 2%, growing, let's say, at 8% a year to 8. In 8 years is a 5% yield on your cost. That's where I go the 285 comparison to old Yogi. And that 5% yield on cost in a very reasonable, and that's actually half of our current dividend growth rate, just to be conservative. I'll put that 5% up if you're willing to wait a little while over any of the higher yielding 3 or 4 or 5% that don't grow. Because to me, the whole question we're trying to solve for is down the road just a little bit. How can I get not more growth or income and all these allocations and decisions every year that keeps changing? I think what investors need the very most for the next 30 years will be growth of income. So then next to all that is the dividend growers happen to also be fundamentally superior than most of the high dividend yielders. And that's not even close. And that's a whole other topic.
It's funny because when I originally met you, like our mutual friend, Wes Gray, I'd written an anti-dividend article and he forwarded it to you. And he was like, "Oh, I forwarded your anti-dividend article to this dividend guy." And I'm like, "Oh no, this is going to be really bad." But it turns out we were completely aligned because I was writing an anti-dividend article as a value. And what you're doing really is the opposite of that. You're really using it as a quality factor more than a value factor when you look for companies that, pay dividends.
Well, I loved that meeting of the minds because I think what anybody listening to anybody that's trying to help, I don't think this should ever be about what we like or what we want or what we predict. I think it should all be about what they need as investors. So I didn't start my career as a dividend growth guy. I came to it with just mounting evidence. And the fact that over that 30 years, what's changed a little bit around the margin that makes your question just and even more appropriate to think about strategically is, are companies changing and are increasingly the best of breed companies creating so much cash that some old-fashioned growth companies are turning into pristine dividend growth companies, and all of them are outside the traditional dividend fund models. They're not catching these turns, which I find exquisite in terms of risk and reward.
Yeah, to your point, I mean, some of the great Mag 7 type companies are paying dividends. So it is the profile of the type of company paying a dividend is changing over time.
And there's fun examples of, previous CEOs of big old companies like Apple. We will never pay a dividend to, if you got that first dividend, I think you're at about 25% dividend yield on cost and climbing. And if Apple stalls or if the market rolls over, try to rip out of somebody's hands something that's paying them rent checks. If you owned a portfolio home, 25% yield on cost. If my math is right, it's close.
What is the fact that a company is able to consistently grow their dividends? What does it tell us about them as a company? I mean, as a quant, I would probably use the word quality, but what does it tell you about a company that they can do that?
I think it's a great question. And to be clear, it is not an absolute. So there are plenty of dividend yielders, to Justin's question, just like there are dividend growers that don't work, that will cut, that are in trouble. So it is not by itself a factor that I would focus on. No different than I personally can't get down kale by itself. But if I mix it in with enough ingredients, I've got a shot. So to me, it also is such a great question if you put it next to the debate. My favorite debate that I'll play strong evidence devil's advocate to are these companies that, if you're growing your dividend or even paying a dividend, you got nothing else to do with your money. You don't want those. You want high growth companies that would never pay boring old dividends. Sometimes that is true, but what if you sit in a hunting blind long enough, if you wait for all of these ingredients to converge, where you have a company that's printing so much cash that it can not only pay a growing dividend, but pay or eliminate debt, buy back shares. So all of a sudden, why have this debate about buyback versus dividend? Why not the answer be both? In my very, very selective, greedy mindset, let's have both. And you can calculate these with, we call them stakeholder yields. Instead of just dividend yield, let's calculate the buyback and the debt pay down for a true three-way stakeholder yield. So I just like both. And you can be greedy if you believe in a concentrated portfolio.
And so do you migrate your strategy over time to account for that, to account for the fact that more people are using buybacks and it's not just dividends?
Absolutely. And I love both. And some of these companies literally have so much cash, they can do all three and expand their operations. So, because again, this is where some of these big dividend payers are not growing. And some of the famous strategies, aristocrats and the big traditional blue chips, they may actually be slowly leaking and not growing over time. So I want all three of those, plus they're still actually growing as a business. I think the notion of growth companies or dividend companies is entirely miscast. I don't think it's the right question.
Yeah, it's interesting too, because your idea of focusing on all these other factors, and we'll get into those as we go, but you see a lot of companies get into trouble with that. Like if they're on the aristocrats list and they go through 2008, they're like, we can't cut the dividend. We're going to do all these other horrible things for our business because we just can't cut the dividend. So sometimes it leads to like a suboptimal, system that they're using.
I think it's a really subtle but big red flag, actually. If you're growing your dividend at 0.9%, that tells me you really, really, really want to stay in somebody's flagship strategy or titled or licensed name more than you actually have more cash. And you can see it. You can see it in all sorts of measures, and as we use, instead of the very traditional and somewhat crowded, you'll notice all of our combination of factors is centered around finding uncrowded opportunities, even if they become crowded later because everybody agrees with us. But the payout ratio, which is most dividend investor and funds' favorite factor to measure the quality, we actually want to make it harder. We use the free cash flow payout ratio. So to your point, if an aristocrat's growing their dividend at 1% just to stay in the index, and they're paying 130% of free cash flow to do it, that's a really easy to find red flag. And yet most investors don't know. They don't ask, and they're in those strategies.
How much does starting yield matter to you? I mean, we know that companies that consistently grow their dividends, they're not going to be paying an 8% yield to start because those companies usually can't sustain the dividend. So how do you think about the starting yield?
It's a good question that we do not have a strict floor number. There's a little bit of nuance in the way we've been able to manage it over time so back to our 30-year history, we have one of our two equity strategies. We have, next to the dividend growth, we have a pure unconstrained upside compounders account. So if a company hits all of our criteria and might yield 0.5%, that might be much more appropriate, especially if it's a faster grow in our compounders account. So there is the ability to hold lower yielders, for us anyways, outside of this dividend strategy. But to your question, my framework is, again, not what I think or want or predict. If it's all centered around who we are serving, then I want to answer the question, our own barbell to clear is, I want to compete with the most agreed upon crowded financial planning strategy in existence, which is the safe withdrawal rate. You'll notice my Yogi Berra math at 5% exceeded simply the 4% supposedly safe withdrawal rate, which our math says is not so safe. So my framework is, if within 5 or 10 years, if we can exceed that safe withdrawal rate of 4, and to your point, Jack, that could be done with a starting yield of 1 or 5 or 6 or 7 or 8, and we have all, then it is a candidate. And then that's only one of the factors to be included in the roster, right? But to your point, it is absolutely a factor because we want to get there. We want to get there for an investor.
Is your strategy a pure quant strategy? Do you use a mix of quant and discretion? How do you think about that?
Pure quant filters where it's zero opinion of our own. And then at the very tail end of a little bit of the art and hanging on the wall after the architecture, we will override the selection process so that it's not 100% consumer discretion or staples or energy or technology. I believe, and have just seen every single market, I want, no matter which one is underperforming, I want an equal balance of all sectors. So there's a little bit of art that comes in there. And then I also we will use buying and selling pressure. Some people call that technical analysis to see, I want all of the quantitative factors in a fundamentally superior portfolio, but then I also want to see, is it for reasons that I don't know and the numbers don't know yet? Is its relative strength outperforming or underperforming its own sector, not the market? So you put all three of those together, then you got a shot at cracking the roster.
Yeah, momentum is interesting in that way. Like it's great as a supplemental factor in that way, because it seems to take into account everything that we might be missing as portfolio managers, because the market is giving us some degree of truth with momentum.
It's one of those debates since we've been in the business together that I chuckle when I see all these people argue and fight over fundamental versus technical or momentum, when history's pretty clear. If you buy cheap stocks that have momentum, you could have your eyes closed and outperform most professional investment managers. So we incorporate that simple data.
Yeah, unfortunately, those of us that are value investors have learned what it's like to buy cheap stocks that don't have momentum for a very long time now. But what is I would think dividend growth companies would perform very well in market volatility, downturns, things like that. Is there any data to suggest that they are more consistent in that way?
Yes, I think Ned Davis probably has the best treasure trove of, and they break down the S&P just as an example, which would not be a benchmark of ours, but it's a pretty decent start of really high quality companies. And they separate them by companies that pay no dividends, companies that cut dividends, companies that pay dividends, and companies that initiate or grow dividends. And over my entire lifetime, and I'm sure much longer than that, dividend growers, and this is not the reason I own them for total returns. Again, I'm counting for planning purposes, we include zero appreciation upside. All of that is gravy, but the reality and the data is that dividend growers outperform every other one of those groups in the S&P substantially over time. But my own 2 cents to the earlier, what I think is more important for an individual investor that does not care about that chart hanging on an advisor's wall is when really it gets tough. And the best answer to the question for me would be asking any investor that we've served for 30 years during not just a 25% market correction over a month we had recently, but we've lived through 50% market crashes. If you flip over that back of the envelope test again, not a 38-page report from Wall Street, did you receive your mailbox money check again, no matter what the market was doing? If the answer is yes, you have permission to ignore all of the other news and politics. We can talk about them, but does it really matter to you? And I love when their head hits the pillow to know that answer.
How do you think about this type of strategy from a behavioral standpoint? Because one of the things I've learned in my career is, like, at the beginning of my career, I'd always be like, you need this, you need value, and you need this, and I'm going to jam the value down your throat. But some people believe in certain things. And when they invest in something they believe in, they're more likely to stick to it. And I was thinking about that point you made about yield on cost before, because some people who just deal in numbers might be like, yield on cost, who cares? I need to worry about the current yield. But the reality is, if I know my yield on cost, and I know that I've held this company for a long time, I'm probably going to be much more likely to stick with that strategy and not want to sell this thing that has an 8% or 10% or whatever. I'm sure they get to huge numbers when you hold them for a long time, yield on cost. So how do you think about that, the behavioral aspect of this?
I think as much as quantitative research-driven analysts and portfolio managers like us would like to think otherwise, I think it's the most important. There's average annual returns on all of these products and strategies, and the actual investor returns. And those numbers, as we know, brothers, are starkly different. And I don't think that gets talked about enough, meaning Fidelity Magellan, perfect example, best performing fund when I was growing up in the business, Heroes, best stock picker out there. And the average experience inside of that fund was dreadful. And that was behavior related, right? I mean, the portfolio manager did their job, but coming in and out at the wrong time. And I think to put a specific point on the yield of cost, I vividly remember, because it's a two-way street. Somebody's got to do the math that works. It's got to be a repeatable, discipline-laden process from the portfolio manager side. But the investor, in a true partnership, the behavior's got to matter too. So I'm sitting having breakfast before I knew anything about anything in the late 90s in Silicon Valley with a guy who said, I know I've got enough. And I hear you're somebody who can help me diversify out of technology. And I had no business being at that table yet, but for the kindness and trust of somebody who put us in touch, it worked out well for him. But he took a leap of faith. I remember that not because I had any chops yet, because of his humility. So that's key number one for your question. And then being able to diversify, and for him, buying a boring energy stock from a guy in Texas, he didn't know anything about it. But it works, and that 3 or 4 or 5% yield now is substantially higher. No different than when I, 30 years later, go to a good old boy in Texas who wants nothing outside of energy. And I said, hey, brother, there's some technology companies, believe it or not. And the reason, of course, I remember him is his company that he sold to a little technology outfit called Broadcom is now at, when they started their dividend, I think it's like at a 16% yield on cost. And nobody ever thought of Broadcom as a dividend payer. It's over the last 10 years, I believe it's averaged current yield about 1% or 0.9% at any time. And yet at the end of that 10 years, a 16% yield on cost. To your question, no matter how volatile technology gets, it's going to be difficult to rip those shares out of somebody's hands, getting paid while they sleep, while everybody else argues.
Yeah, to your point on humility, like I think that's probably like my biggest learning of my career is I think the curve of humility goes up. As you know more, and you probably should be less, you learn you know nothing about what's going on, and like you made every mistake in the book, and like I'm probably the most humble I've ever been now, and it'll probably get worse as as time goes on.
I couldn't agree more. And I guess we're just hardwired. When I talk to young people or interns or people that start here, I'm like, if there's one discipline that's built this entire firm that I didn't have either 30 years ago, it's curiosity will beat conviction. So just stop being so convinced about whatever in the world we're convinced about and have an open mind, and you'll collide with a little bit more luck that way. Plus, I think it's a funner way to live life.
You mentioned the aristocrats before, and there's a lot of these types of dividend strategies out there, the dividend kings, the dividend aristocrats. How would you compare and contrast those types of things to what you're doing?
We pay a lot of attention to it because left to their own devices, investors could do a lot worse than just owning those indexes. And so when we launched, especially when we launched the ETF, we were doing just fine and always going to serve people well. But like, okay, now that the results are out there, I don't want to launch this unless I knew we could compete favorably. And I knew we could just by backing into the math. Some of those companies are past their prime. You don't have to, it's not an opinion. You can just see it mathematically. I mean, some people are shocked at the number of even S&P companies, let alone aristocrats, that are not even growing their top line anymore. So forget free cash flow and dividends. If you're not even growing your top line operating revenue anymore, I just choose not to own you before I even worry about selection process. So to me, that's another opinion I'll mix in here. I think an active versus passive debate is also misplaced. Everybody's an active manager, whether they like to believe it or not. But just through process of elimination of not owning some of those companies, most of those aristocrats and blue chips, and there are some good ones, to be clear, they got popular. And there's also a little bit of nostalgia. You mix a little Buffett and Munger, and how could we go wrong by owning some of these best companies? And again, you could do a lot worse, but the math suggests that some of those moats, which a lot of investors grab to as, that's what I want. Give me a wide moat. And that can be true, but it also can be lazy because I want a moat that is expanding of any size. I'd rather have a small moat that is expanding at all than I would a big moat that's overvalued potentially that might be leaking, meaning you're not even growing anymore. So not only is the company not as healthy, but you have investors perhaps overpaying for that tradition, which is what I think can trip people up and why the kings and the aristocrats, I think, are easy to outperform just mathematically.
Yeah, a lot of it is like the metric, like we talked about before, the metric you're optimizing on. So if you think about a strategy like that, what I'm optimizing on is pay the dividend no matter what, because I've paid the dividend 25 straight years or whatever it is. And sometimes you can run into trouble with that because all these other metrics that are behind the surface that tell you about the business, those can get lost in pay the dividend every year so that I stay on this list.
And it can create and reward some bad behavior by continuing those streaks and sweeping stuff away or not looking and then being short-sighted perhaps, which again, there's some, we own a few, but I just, no different than any index. I just wouldn't own them all.
So it's time to nerd out a little bit because that's what we like to do here, Ryan, on the Excess Returns podcast. We want to get into your your actual process. You have a great process in your documents about how you go about doing this. And the first part of your process is you look for an operating business advantage. So I was wondering if you could talk about what you use, what criteria you use, and how you measure that.
So I couldn't help it. I can't wait to get into the nerd process. I already peeked under the hood with you, and it's all centered around. So looking at that simple top line operating revenue to begin with, no different than income and free cash flow. And then where we really roll up our sleeves is looking at those absolute numbers, which is easy for anybody to see and find, and perhaps overpay for the clear winners and maybe have some short-term bias in there. I want to see the change. Is a big grower decelerating? And I might avoid that. Or what we really, really want to wait for is, and to use your aristocrats example, there's companies that have just started paying a dividend in the last 5 years, for example. That change and then that growth rate, a 25% grower instead of a 2% and hanging on for a dear life grower. It's that rate of change that I've found it's not perfect, but it's the best clue of the intersection between improving fundamentals and a little bit of uncertainty. The crowds haven't quite picked up on that in mass yet. Just like that previous example of a former tech growth darling with all the risk and volatility to, did anybody notice when they started paying a dividend? So that rate of change is really, really important to us.
How about the quality of the dividend and its growth? I mean, we've talked about this a little bit before, but this idea that what are the metrics I need to be looking at to determine whether this company can still pay its dividend, but also whether it should still pay its dividend, because some of the things we mentioned before, maybe companies that got away with paying their dividend, but they should have maybe stopped paying their dividend and focused somewhere else in their business.
Absolutely. So the quality and the safety of that dividend is at least as important equally to me as its yield and its direction, and the best predictor. And there's no perfect ways, but there's a whole heck of a lot of good clues. And I mentioned earlier, the payout ratio is the easiest one that anybody can do on their own. And what that means, if you're just listening for the first time, is taking the percentage of earnings of a company. What are they paying that out in dividend? And the aristocrats, for example, they're on average paying 2/3 of their earnings out as dividend. So I would like to pay significantly less than half, number one. And then further, I want to measure it as a percentage of free cash flow. So then you really get back to the oxygen. If oxygen of a company is free cash flow, if that's the best way to measure the health and the direction, I want to measure the free cash flow payout ratio as the quality. Next to its balance sheet, its debt. We mentioned earlier, is it buying back shares? Is it issuing shares? All of those measures the cash, and that those quality factors of the dividend, is it sustainable? Also, a clue there that we just hit on is, okay, if all of those line up, the dividend should, back to where we started this whole conversation, the dividend should be increasing at an accelerating rate. If the cash is coming in, if it's growing, I don't want 8% per year dividend growth every year for 10 years like that Yogi Berra math. I made it hard on us earlier on that Yogi Berra math. I want 8, 15, 25% dividend growth. I want that accelerating too.
So you're not looking for a certain level of dividend growth. Your key here is that the dividend growth is going up over time.
Yes. And again, since we want to be in all sectors and balanced, there's definitely different animals, and we'll measure them unto their own sector and their own universe and their own history. It is not an absolute number across the board because different businesses have very different needs.
So you have different criteria. You know, when you look at sectors or when you look at different groups of stocks, you'll apply the criteria differently, obviously knowing that they're can be completely different to businesses.
And the way we do that, instead of the traditional filter and stock screen. So back to my nerdy days a long, long time ago in the back of that baseball card shop, I hold what I affectionately called stock tournaments. I hold them on the weekend because, as my tip of the cap, and my kids have heard this about PTO and flexible schedules and how many days a week. I was like, when I started, it was, do you want Saturday or Sunday off? So I worked 6 days a week. And so I still, in honor of that guy who started in the mailroom on Wall Street, on Saturday mornings when the markets are closed and the phones are off, I will feed every single ticker into our quantitative tournament, separated by sector, to your point, and I will make them compete against each other on all of these different factors to create a bullpen of finalists that we will then go through one at a time.
It's funny. My dad always makes fun of me for that because he works 6 days a week too when I was growing up. And I'm always complaining, "Oh, I'm doing all this hard work." He's like, "Please." He's like, "This is nothing what you're doing," which he's probably right about that. I'm sitting in front of a computer all day. It's a completely different thing.
I learned it from my good old farm boy dad who grew up. He didn't have a choice getting up early in the morning. I would always do it before the kids got up, so it would never interfere with personal time. But I just love that quiet time when I could really, really nerd out. And that's how I view. I mean, you don't have to be nerds like that's how I view the stock market. It's a series of choices, and what's critical to me about the tournament analogy is that when the inputs change, so should the outputs. Like the company may be no different at the end of the week, but its asking price might be. So all of a sudden, a 16 seed might be better poised to upset that big old moat number 1 seed.
You mentioned value, and you mentioned earlier that you pay up sometimes for some of these companies, which I think is one of my lessons from what we've been through in the past decade. Is a lot of these companies that maybe looked expensive were actually expensive, and buying these, dirt cheap companies didn't work out as well. How do you think about value though? When you look at these companies, like what metrics do you use? How do you think about determining if the price you're paying is fair?
It's a really good question. And I think even Buffett gives credit to Munger for changing his perspective a little bit, right? And paying more for quality. So I am flexible. And there are exquisite companies that are at high valuations relative to the market, but that are cheap unto themselves. So one, we look at their valuation on their own history. But my criteria, and again, back to the nerd at the baseball card shop, the old Moneyball movie, I think of this as a roster. So at the end of the day, the back of my baseball card, if you add up all the fundamentals of all of our holdings, I think there needs to be a lot of different kind of players on that team so that the average of the team, I want that overall team valuation to be cheaper than the market, even if it includes a few that we can afford to overpay for. The scene of Moneyball that I just love is the guy that nobody wanted, kind of like Yogi Berra, the big old fat catcher. The quote in the book was, if the guy was wearing corduroys, he would start a fire on the way to first base. And they liked him because he got walks and he would just walk to first base. So that guy may be really, really cheap, which can then let you afford a superstar maybe at one of the corner infield spots. So putting that roster together, I also think sets you up exquisitely well as an all-weather portfolio where you're not underperforming in high growth markets where people are overvaluing and favoring those expensive companies. And you're holding up a lot better because you have some really, really cheap players on that roster too. I want a roster of even only 50 names to be more diversified in both growth and value than a series of a dozen funds. That's another criteria I want for an investor.
So is 50 names the number of names you have in the fund?
No more. Yeah. So right now, no more than 50. I think we're at 49 right now.
And how do you think about that number? I mean, I would think to some extent you can have a more concentrated portfolio when you have these type of high quality companies because on their own, they're less volatile. But how do you think about coming up with the number of holdings you have?
So back to my early days, starting in the 90s on Wall Street and reading and voraciously being curious and never knowing that answer. And by the way, I don't think there is an absolute answer, but all of the data that we poured through, you start to meaningfully lose the benefit of diversification beyond 40 or 50. So it's not a hard and fast rule, but the bang for the buck, the sweet spot we found for anything is 40 to 50. There's nothing wrong with 55 or 100, but you lose the benefit of diversification. And if you believe in your selection process and it works, I want a little bit more concentration in what will work. And I guess to me, the more important part of that question is letting your winners run and then cutting your losers inside that roster. But I think it's pretty clear, although there's nothing wrong and plenty right with a passive index if you don't know anybody that nerds out on this stuff. I think thousands of companies, I think anybody could argue, if given enough time locked in a room with a bunch of nerds, you could find 50 of anything out of a group of thousands that stands a little bit better chance if you use both growth and value metrics.
That letting your winners run is so important because we actually did a test on this a long time back and we looked at like more of our deep value strategies and that idea worked there too. Like the idea, you think of the value strategy, I got to sell the stuff that's up and I got to buy the stuff that's down, but like letting the winners run and, cutting back a little bit on the losers, it actually worked out really well, even in a value strategy.
And so what we learned there, and the data is pretty clear, and there's a little bit, it seems easy to me, but I think it's the discipline as a portfolio manager and investor. I believe in equally weighting all of your best ideas, not with conviction, pounding the table. This is deserved, so that if a big position results, it's from winnings, not your conviction. And I would also never add a red cent to a losing position, which is part of the sell that kept us in business for 30 years.
You mentioned sector concentration earlier. Like, what are your feelings on that? I mean, will you let a sector get pretty big? You mentioned you have to cut it back sometimes, especially, I guess, I assume the dividend universe is a little bit different in its sector concentration than the overall market. How do you think about that idea of sector concentration?
We've been fortunate to perform very well against traditional dividend funds, mainly because of the fact that a lot of those traditionally cluster around big defensive names and consumer staples and utilities. And if you just force yourself, and there's no magic wizardry here, but just wanting to be exposed to every single sector, which is a simple rule here, we've done exceptionally well because some people are overlooking dividend growers, and we mentioned technology. Now, will we underperform against a 30 or 40% technology index? Absolutely. And I'll sign me up for that any day. But I want to cross sectors. I mean, I guess our biggest uncrowded position that would stand out to your question against the market right now is the market's 2% energy, and we're double digit. And it's not because we have conviction on energy's future. It's because if you measure the market from cash flow and dividends and real income and operating cash flow, energy is just wildly underinvested. So it's not a predicting energy's going to go from 2 to 10%. We're getting paid substantially just from the cash flow that I think is misrepresented in the S&P.
Just one more for me before I hand it back to Justin. How do you think about selling? This is something that all of us probably struggle the most with, which is when to get rid of our positions. And I'm thinking about the idea of, like, if a company cuts a dividend, do you sell? Like, how do you think about the criteria to use when determining whether to take one of your positions and sell it?
Well, this will be what most people will, including professionals, will disagree with me about, that I think any investor can take. And I would give them a chance, like the old turtle trading experiment. I would give any room of investors a chance to outperform professional money managers if they adopted any version of sell disciplines on their strategy. So with that frame point, and that's how uncrowded I think this idea is, my answer is we have a sell stop for every position before we put it on. And it is a criteria of different things individual to that position, not the market. So the market rolling over 20%, we're not getting stop loss on those positions. Each individual position has its own sell stop. And if I had to look back in every scenario, that is, and it's, we're not heroes. We're not predicting the future. If you just have and I think it works in life too. If you did know when to walk away, which includes first and foremost what I said earlier, not adding to a losing position. That's the hardest, because every professional money manager, the best, and I'll add a little teeth to that comment a minute ago, the best professional money managers in the world, if they get carried out on their shield eventually, and a lot do, it all has the same two ingredients: ego and no sell discipline. They added more to a position that they were convicted over. If you simply close that barn door to that possibility, I think you have a real chance of outperforming even the best and brightest. Now, if you put that together with a good selection process, then I think you're in really good shape.
Is that individualized stop? Is that just a price thing, or is that a bunch of other criteria you're thinking about as well?
Fundamental, price, and I mean, use your example. A dividend cut would be an easy one. Absolutely. Thankfully, that doesn't happen to us very often because of the criteria we use. But if any one of these criteria, and we have a list of a lot of them, we shoot first and ask questions later. We do not have a committee this is where people get in trouble. Talking, debating, and all of a sudden a week turns into a month, turns into, oh my gosh, we're down not 25%, we're down 75%. So it's all very disciplined, set ahead of time. And I think that's a good discipline for anybody. What is, before you buy it, how do you know when you're out? And we have that answer before we started.
I just wanted to go back to the sector point that we were talking about before, and you were kind of talking about the exposure of the sectors that you have in the portfolio. And just tell me what your thoughts are on this. Like, it seems like some of these big technology companies, it's like they have the growth, but it's almost like, and they don't have the same characteristics, but they've almost become like staples. So you get this like almost protection like they almost behave like staples would in, volatile periods because the businesses are so sound and healthy. Is that your observation as well? Do you kind of see what I'm saying?
I absolutely see what you're saying. And separate from our strategy, I think that's probably what's confusing most investors most of the time right now, which their knee-jerk reaction is, oh my gosh, the market's too heavily weighted to these big tech companies. And what if the name of the sector were changed? Would it still be the same? And I do think that rebalancing, and that's why we don't start out with a preconceived notion of where we must be and fit in. But I do think some companies are now miscast because the world does evolve. And some of these tech companies, I think, to your point blank, I think they're absolutely consumer staples.
So we started sort of high level. We came into the strategy and talked dividends. Now let's kind of come out of it a little bit and talk about some of the other things that you've talked about or written about. And the first thing I wanted to ask you is, a lot of the industry still promotes and clings on to this 4% rule. So that's, you can take, if you have $1 million, you can take $40,000 or 4% a year out to live off of if you're in a balanced portfolio. Hopefully you don't run out of money over the next, 30 years or whatever the predictions are. But, you kind of have talked that kind of thinking might be a little bit outdated or dangerous. So can you explain that?
Devoted a good portion of our careers to this question. So yes, and to be fair and to honor the professor at Trinity University down the road in Texas, who originally wrote the paper, you could do a lot worse than clinging to that. There's nothing wrong with it. I just think there's better. No different than indexing. There's nothing wrong with that. It's a lot better than when I started out in the industry. Financial plans were walking out the door at the biggest global bank and brokerage firm in the world, showing people that if the market goes up 10%, you're cool if you take out only 7 or 8. The best advisors in the world were printing those plans. My last meeting before I was leaving the door with still wonderful relationships and friends there, I showed them on the big screen. I was not terribly popular during that lunch. Was okay, over the last 30 years, how did that work? Because it a little bit less risky, but 4 or 7, it's the same if it's a static number. So that previous 30 years, the answer is no matter how many millions of dollars you had, if you're taking out 7 and you were making 10, you were bankrupt in 13 years. When I shared that in 1998. The safe withdrawal rule, I think, while it is just fine, what bothers me the most is I think it's confusing to investors. It's supposed to be, if it's supposedly safe and a hard and fast rule, you shouldn't get millions of Google results if an individual investor asks, what is the safe withdrawal rate? There are now more gremlins jumping out of that original rule and more variations and guardrails and different versions. And am I supposed to add to it during inflation and what happened? And it's overwhelming. And back to our agreed upon point, if anxiety and peace of mind and behavior is the key sticking point that will unravel or not a plan, I just want more peace of mind. So the math suggests, and to be fair, that original author of the safe withdrawal rate never took people through 30 years. And most of the folks that are sharing those plans, the average for the advisor, they're retiring in 3 to 5 years. So there's a little bit of a conflict there. So the math would suggest, what if, so my simple rule for that is, if anybody tells you about a safe withdrawal rate, just say WHOA, which my acronym of withdrawing hopes of appreciation, WHOA, and we have a research paper on the site. It's not a plan. It's a prediction. So any plan that requires the market to work, no matter how you ratchet down the numbers and account for inflation or risk, at the bottom and footnote of all of these simulations, Monte Carlo, safe withdrawal, all these financial plans that I politely walked away from, not because I was smarter, just because I learned over 10 years on Wall Street, I learned what didn't work. And I learned all the footnotes and I learned where all the class action suits eventually result in. And the footnotes will be clear at 80% chance of success. And I just don't want to tell somebody one of the next 5 times you're driving home, this is not going to work. So if you flip that safe withdrawal rate over and you say, if you create a portfolio, not just with me, but any recurring income streams that exceed that do not require appreciation, let that all be gravy, then I think you have something substantially more durable than a plan based on predictions.
Is this the concept of the mailbox math that you guys talk about?
The mailbox math is just, again, if everybody forgot any of this, if you could turn over the back of an envelope, that 285 math of taking any starting yield, using the growth rate, picking any year in the future, what your own dividend on cost, that would be mailbox math. Now, I affectionately call mailbox math now, and our partners that we serve affectionately group all of the income sources, including the safe, risk-free, AAA good old-fashioned tax-free bonds, all of those recurring income sources. They affectionately call that mailbox math. And the partner of ours that drew our sweet little logo just said, and I believe in it, it meant a lot to us when he said, I want to be the one guy in my neighborhood. No matter how many rich friends I have, they've always got that red flag pointing up with invoices going out. I want to figure out a way someday where it's a green flag pointing down, where I have more incoming sources than outgoing. And that mailbox math, back to the behavior question, I had a partner who just summed it up best. Of all the stuff that I'll outsource at my business, all the stuff that's confusing that I hire bookkeepers account, I personally still like walking to the mailbox to physically pick up a dividend income check. And I never forgot those words 25 or so years ago. That consistency, one of the only things in the investment world that has not changed in those 25 years, that consistency compounds unto itself with some pretty magical results. So that's mailbox.
So at Freedom Day Solutions, you'll find things like on your site, like, asking questions like, am I going to be okay? Or how much is enough? So why do those questions matter more than, sort of some financial plan that someone's putting in front of you?
It goes back to I want to give people permission based on what we've learned and the battle scars we've had and going through 50% market crashes and seeing every single investment product under the sun, that really only two questions matter, no matter how sophisticated, rich or poor you are. And that deep sigh of relief for even investors if we all take our masks off and try to make this easier and really feel comfortable talking, I think that's a big challenge on the financial plan side. That permission and peace of mind, I've found, unlocks some doors. And I've really just seen it to be true. So knowing that you're okay, having something completely removed from all of these investment questions that is purely safe, not in a convoluted fixed income product, pure organic ingredients, insured income streams, tax-free municipal bonds, treasuries, pensions. Also knowing that I'm going to be okay if something happens to me, so that my family will be okay. Knowing that you're going to be okay and have something removed from risk, which is what I've seen done most wrong by most investors. They do not have enough removed from harm's way. If we answer that question in any size, then the only other question left for most people is, how do I know how much is enough? And mathematically, we can show them. But then finally, what does that create inside them and their minds and their creation, their creativity and their relationships? If it unlocks maybe even a healthier, longer life, which I believe, knowing how much is enough, either as a target, and we'll see people that elbow each other, they're saying we can do this now. We thought we had to have it, or maybe that's tough love. How much is enough? And the example we have on the website is we have two people and we share their true stories. One lives on $9 a day on the front row of the Pacific Ocean, lives like a king, and says, Ryan, I only need a couple of cervezas and my buddies and a surfboard every day, and it's enough. That plan is a little different than somebody who needs all of $700,000 a year in income, not because he's lighting money on fire. He's an aggressive giver. And part of his plan needed every aspect of that. So it's a simple question of, to get to either one of those numbers, you can back into it with simple math. Do you work longer? And I think work is the most underrated part of any investment plan, the earnings power. And to show that it's not about us or the investments, and to prove how different these can be, those two happen to be brothers, which I find delightful as an example of this can be done a lot of different ways. And it's not the markets, it's choices.
Speaking of work here, as we get to the end, I think we first had you on, to your point, the ETF was just getting started. You launched it on ETF Architect's platform. As of today, there's, 120 something million, in the fund. And, but you're a small firm. You've had to kind of figure it out on your own, with good partners, of course. But what would you think, say to other small issuers looking to enter the ETF space? I mean, what's the biggest lessons you've taken from launching the ETF and actually building it?
I would not recommend it to the faint of heart, or hardly anybody else for that matter. I mean, when I said David and Goliath, I was being polite. It made David versus Goliath look like a pick'em contest compared to what we did. I had a little bit of an unfair advantage, to be clear. So, and I'm objectively, to answer your question, it's exceedingly more expensive than most people realize. It's a great deal for the investors. So you have got to have staying power and capital.
Mm-hmm.
I was lucky, having worked so hard on this for so long. I knew it worked, number one, but also I could seed it. I had skin in the game, which I think is probably the most important question any investor could ask anybody at any time. Where is all of your own money? And shockingly, most of all of our peers, including fund managers, the answer is none of it is in their fund, which I find more important than any other question we just talked about. So I had the staying power. So I knew it was going to work. It was only a matter of time. And also, I didn't need to be a hero. I didn't care about being a rock star and a media darling. And we had zero marketing. It didn't matter if it was an overnight success. I was going to grind to get there. And all I cared about at that time, and this focus helped me, all I cared about is if all we did was serve people that already trusted us, if we're able to luck out and meet new people as a result of sharing our playbook, I'm delighted. But the good thing is I was already happy.
Yeah, no, it's nice. So our standard closing question, right? Well, actually, it's the second. We've already asked you the first one. So we have another one that we like to ask, which is, what's the one thing you believe about investing that the majority of your peers would disagree with you with?
Well, I mean, we hit on both of them. I'll double down on, it sounds simple, but most people disagree with me on sell discipline. Professional. And that goes back to what's taped on my quote screen that I learned by watching all these best and brightest as I grew up. Curiosity beats conviction. Don't have conviction. Don't double down. Have stop losses on everything. And it's easy to say, and just like the rules on dieting are really easy and available and free for all, why is it so difficult? And there's not a wonder drug, unfortunately, for portfolios coming along. So I quit desserts 5 years ago as an example. Instead of buying new blue jeans, change something else. I'm eating desserts. That's a sell discipline. If people disappoint you 3 times in a row, maybe move on to the next person that might be able to help you. So sell disciplines would be one. And then what I mentioned that's most surprising to most investors is the skin in the game. I don't think they choose to disagree, but they're just either distracted or have different motivations. And I think they, show me somebody's incentives financially, and I'll show you what they're probably working on. Ask them where their skin is in the game. I want to sit down with a chef, and I don't even want the menu. I want you to tell me what's freshest. What are you doing right now with all of your own ingredients and your appetite? And I will take my chances. That's what I want.
Good stuff, Ryan. Thank you very much for joining us. And hopefully the next time we have you on, you'll be at 500 million in MBOX, and we'll be celebrating with you.
I sure do appreciate allies and friends like you guys. Thank you so much. And I love your podcast as a listener.
Thank you, Ryan.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.